By the way, Paul is not, like I mentioned, you have not quit. You're a millionaire, right? But you have not quit your day job. Why is that, Paul?
Just hit $1 million. Well, because $1 million isn't enough for me to retire, to where I don't have to work. So I'm still working. But I anticipate full financial freedom in a few years. So my story. Let's talk a little bit about me. I was born in New York, and when I was 12, my family moved to Equatorial Guinea in Africa, that little dot of a country in the armpit of Africa. And I lived there for 6 years. I went to high school there. Everything was in Spanish, so I did high school in Spanish. I learned how to speak Spanish and French. My parents were German immigrants. We had no support system. We were really poor. I started working from a very young age, like from 9. I was selling cakes and flowers around my neighborhood. And when we went to Africa, actually, that trend continued because my parents were volunteer missionaries. So they had no income. And I don't know, they just kind of went on a wing and a prayer, but we survived. We did all right. My mother started making cakes there, so she was a star baker in the city. And so we did all right. And at 19, I came back to the US. That's the capital city, Malabo. That's me teaching English. This is me selling cakes around the streets of the city. And then at 21, I joined the Air Force as a Pashto linguist, and that's a military translator for the Pashto language, which is spoken in Afghanistan. And I took some classes at Pasadena City College in LA, but my life was going nowhere. I'm making maybe $1,100 a month, splitting rent with 2 other guys in a cramped 1-bedroom apartment. And like many immigrants, I had no support system. I was broke. I was having to put gas and groceries on a card, and by the time I joined the military, it had about $4,500 of debt on credit cards just from necessities, right? This is me in Afghanistan, and this is me totally meeting Robin Williams when I was in Afghanistan doing a USO. So, woo.
Wow.
Really nice guy. Anyway, for the first time in my life, I had more money than I needed for my basic necessities, which allowed me to pay off my debts and save. So I joined at 21, and I joined with about $4,500 in credit card debt, and I bought a car shortly thereafter. So I ended up with about $25,000 of debt. And by March of 2010, I was 25 years old, and it took me 4 years to pay off that debt. And after I got out of the Air Force, I struggled for a few months to find a job. And the only one I could find was working in a UPS warehouse, just like loading packages and stuff. And it was $10 an hour to start, but I quickly became a supervisor, and my income doubled, and slowly, built my income from there. And thanks to the military service, I was able to get the GI Bill, which I was able to go to school completely for free. And I even got a stipend, a monthly stipend. So GI Bill is an amazing tool for those who qualify for it. So I got my bachelor's in finance, and I got a master's degree in business intelligence, MBA. I was working for UPS at the time, part-time, and going to school. And when I finished my MBA, I applied for and I got hired to a financial analyst position, and that one lasted 20 months. And then, but at the beginning of the pandemic, they're basically contracting everything down to operations. So I went to operations at the beginning of the pandemic, and I've been there ever since. And so I'm basically back in the warehouse doing what amounts to manual labor, even though I'm like a supervisor. So yeah, those are some of my guys from back in the day. That's them loading some trucks. This is me graduating with I think it was my finance degree. Another thing about me, as I said earlier, I am a millionaire. And this is something I really like to show people. I'm very frugal, and that's how I was able to become a millionaire. I only made, in the last 11 years, I made an average of $59,000, which may sound like a lot to some people living in certain parts of the country, but I live in California. That's where I spent most of these past 11 years. And it's pretty expensive, but I made it work because I always prioritized saving. And just know that the less you spend, the more you can invest. And most millionaires that are self-made got there by saving and investing, living on less than they make, always on a modest income, driving modest cars, modest houses, modest clothing, yeah. So this is how I went from 0 to $1 million in 11 years. I prioritized saving. I spent less than I made. I spent about 50% of my take-home income basically these past 11 years. I invested the difference and I let time, compounding, and luck do their thing. To me, money was freedom. So instead of buying stuff, buying my freedom was more important, because if you save money, someday money will save you. And not having enough money is the cause of 2/3 of life's problems. So if you can, there's 1/3 that no amount of money will solve: interpersonal relationships, addiction issues, mental issues, that kind of thing. But for the most part, having enough money will get you out of almost any problem. Having health issues, you can get the best doctors. Having legal issues, the best lawyers. All that kind of stuff. Having a crappy boss, you can just leave because you don't need the money. And so that is freedom. There's freedom in having a bunch of money. And so instead of buying stuff, I was buying my freedom. I prefer the money work for me rather than looking shiny in my driveway, like if I have a fancy car. So let's see. Yeah, so just I started with index funds. I can explain that later if anyone doesn't know what that is, but it's a kind of a broad-based market fund that contains all the stocks in the market. You're not really picking stocks, you're just buying the whole market and trusting that the US economy will continue doing well in aggregate as a whole. Because I never saw myself as a stock picker. I never thought I was smarter than Wall Street, than anyone else. I didn't really understand this stuff at the beginning. But for me, that strategy worked because it was simple, and I trusted that the stocks would go up over time. But then after I had 6 figures, I had a little bit more money to play with, and I decided to set aside 10% of my portfolio into like risky speculative side gambles. So I bought shares of Tesla, I bought Amazon, I bought Bitcoin, I bought a marijuana ETF, and the first 3 did pretty well. The last one I lost like 50% on. But those are much, much riskier. And I was okay with that because, I had $100,000 or something like that. And I was investing 10,000 of that money into the speculative bets just in case, like a lottery ticket, right? But I'm going to talk about risk in a little bit, and it's very important. So anyway, over the last year, the portfolio doubled to $1 million due to speculative bubbles and those side bets. And that's not what I want people to focus on. I want people to more focus on just investing in general. So yeah, the cool thing is, it took me 4 years to pay off $25,000 in debt, and only another 4 years to have $150,000. And you might be, is anybody surprised by that?
Yes.
And you might be wondering, like, how the heck do you even do that? I like to call this the rowboat analogy. The reason is because when you're in debt, interest is working against you, and when you're investing, it's working for you. So your debt is someone else's investment, right? So yeah, when you're in debt, the interest current is kind of pushing against you, working against you. Some of that effort is expended into fighting the interest, right? But once you're investing, once you're out of debt, it's like rowing downstream. It's much easier. The current pushes you along further than under your own power. And I did all this on an average of less than $60,000. This was my income. Look right here. I made $18,000 in 2015. And I always prioritize saving. I was able to save about $800 that year, even though I only made $18,000. Partly because of my wife's help. We weren't married yet, but she helped with. She made some money too. But yeah, I always prioritize saving money. So let's go to the disclaimer, because I'm going to be talking about investment stuff, and it's important that I put this out there. So I am not an investment advisor, Anything you do with your investments is at your own risk. Don't sue me later and say, hey, Paul told me to do this, and now I lost money. Okay, I'm going to try to explain as best I can, but this is just education. Okay. And just know that investments in securities and bonds, stocks, anything like that involves risk, including the potential loss of all of your money. Past performance is not a guarantee of future results, and my past performance is not a guarantee of your future results. And this is only education, not investment advice. And so when I say risk, what does that mean? Can anyone tell me what risk means in the context of investing?
Risk. Well, you said you lost 50% in marijuana.
Yeah, so losing money. The risk is that you could potentially lose money, right? So
Yeah.
stocks are extremely volatile in the short term, so they can lose money. So like a savings account is the least risky investment you could have because it never loses money. It just slowly grows, right? But something like stocks fluctuate wildly, so you can be down sometimes, right? And most importantly, do your own research. Be aware of these risk levels of investing and do your own research before you do anything. Now, let's talk about why you have to invest. So I'm sure everybody understands inflation, right? You've seen the price of things go up. The value of money has gone down. I remember when I was a kid, a Big Mac cost $2 and now it's like $5. So over the past 100 years or so, the average annual inflation has been 3%. What that means is something that cost $1 last year, this year's going to cost $1.03, and so on and so forth. And that happens every year. So the risk of losing money can be scary, but cash loses value, right? If you keep your money in a savings account or buried in your yard or under your mattress, you're losing purchasing power. However, on the other hand, if we look at the S&P 500, which is the 500 strongest companies in America, an investor that invested, or if you look at historical results, there hasn't been a single 20-year period in the S&P 500 where someone who put their money in lost money. So they either broke even or they made money over every single 20-year period. So stocks are pretty risky, right? But you look at on a daily basis right here, half of days are positive, half are negative. Then you pull out to the quarter, the year, it gets more and more probable that you'll have a positive return during that time period. And this is one reason why it's very important that if you decide to invest in stocks, you have a long-term mindset with this, because there's if you invest for 5 years, historically you have an 86% chance of making some money, but you have a 14% chance of losing money. And so if this is money that you require down the road, so if like you're saving for a house for 5 years, you don't want to put that money in stocks because you have a 14% chance of losing that money. But if you have 20 years to invest, then historically speaking, you will have you're guaranteed to make some money. Historically speaking, not. But again, future. How do they put it? Sorry.
Past performance does not.
It's not a guarantee of future results, right? Okay. Now, before you start investing, this is very important. You need to get out of debt. If you have debt, you shouldn't even be thinking about investing. I know some people who I talk about investments and saving and all that stuff, budgeting and getting their finances in order, and then they're like, oh, what stock can I pick to make me a ton of money to pay this off? And I tell them, no, that's not what you should be thinking about. You need to get out of debt first before you take risks with money, because when you're in debt, you don't have money. You owe someone else money. You need to pay them off first before you gamble with money that is owed to someone else. So it does no one any good to earn 8% in the stock market while paying 24% to like your credit cards. Investing while still in debt is like trying to fill a bucket with a hole. So just like I was saying with the rowboat analogy, you're losing money by continually paying interest. So get out of debt as fast as you can. Set up an emergency fund. An emergency fund is just something you keep in a savings account because it's safe, right, for short-term purpose. Having an emergency fund will keep you from having to use debt during an emergency, so you can just draw from the cash. So next, know your strengths. I don't invest in real estate yet because I'm not comfortable with the active nature of real estate, dealing with tenants, dealing with repairs, property taxes. I don't want to be on the hook for all that stuff, right? So that's why I much prefer stocks. But you may prefer investing in real estate because most people understand the concept of a house. It's tangible. We all have paid rent, so we understand the collecting rent from our investment property. So that might be more your style, or you might be more, better investing in bonds or something like that. So do what you feel comfortable with. Know your strengths. People have come to me all the time, oh, you should invest in this, you should invest in that, but I stick with my course because I'm comfortable with this. So know your strengths, and you want to keep it simple. Warren Buffett is the richest, the most successful investor in the world, I guess, in history, the richest one. And he says, keep things simple. Don't swing for the fences. Swinging for the fences is a baseball term where the guy did all he's got. Don't dump all your money into something expecting it to go to the moon. When you're promised quick profits, and think about this now, there's many ways. It could be an investment. It could be somebody coming to you with a business idea. It could be something that ends up being a pyramid scheme. When you're promised quick and easy profits, respond with a equally quick no. Now, the stock market historically has returned about 8% a year. So like if you have $1,000 in the stock market, at the end of 1 year, you're going to have $1,080. And then at the end of the next year, you'll have whatever 8% of $1,080 is. So it's not 8% consistently every year. It goes up and down, but for the most part, you get 8%. You'll have some investment charlatans who are gonna promise you a 10 times return in a single year, and that's just impossible to guarantee. So the stock market is relatively certain to make 8% average a year over the next 20 years. And it has a certain level of risk, right? So risk and return are correlated. I mean, when one goes up, so does the other. If something seems too good to be true, it means it's not true. Don't trust people with your money. Trust me, bro, is not a good investment strategy. Avoid buddies with a business idea. I've had so many people come up to me asking for business loans. In the beginning, I loaned it to them. The reason they were coming to me was because the bank wouldn't give them a loan because their credit sucked and their business idea was stupid. So be careful with your money because it is your hard-earned money. And again, educate yourself. Two more things that Warren Buffett said. If you don't invest in things you're just gambling. That kind of ties into the whole do what you know. And you don't need to be an expert to achieve satisfactory investment returns. I think over the last decade or so, I've made something like an average of 19% a year. And I wasn't an expert. I started slow. I just put it in a market fund and just let it go. I wasn't really paying attention to any of that stuff. I didn't evaluate companies. But if you aren't an expert, you must recognize your limitations and follow a course certain to work reasonably well. And that is what I did. I went online. I discovered that this was kind of a simple way to do it that had a fair chance of success. So that's what I did. Instead of gambling, instead of trying to pick stocks because I knew my limitations in that arena, I just put it in a market index fund and went for that. All right, risk versus reward. Again, risk and reward, there's a trade-off. The safer something is, the lower the return you're going to get, because people aren't going to pay you a high return for something that isn't risky. There's a trade-off between risk and reward. So whenever you get something with a high return, there's going to be higher risk. So really only cash and government bonds are safe in the short term. These are short-term bonds like treasury bills. They're basically essentially nothing's 100% guaranteed, but they're basically guaranteed unless the US were to tumble. That's why savings accounts pay so little. There's almost no risk of losing your money. I have a so-called high yield savings account with Goldman Sachs, and it's 0.5%, which is kind of ridiculous. That's less than inflation, right? So I'm losing purchasing power by having my cash in the bank. And stocks, on the other hand, can go either way. Like I said earlier, you know, on a day-to-day basis, they can be positive or negative, but over 20-year periods, there haven't a buy and hold investor has not lost money. And so I was 30, right, when I really started investing, sort of like mid-20s, 30. And so I figured I had enough time until retirement to surpass this 20-year timeline. I had 20, 30, 40 years until retirement, so I could afford this risk of investing, right? So the longer the timeline you have, the greater risk can be taken. So younger people do well to invest in riskier stuff, like stocks and even speculative stuff sometimes if it's only part of your investment. And older people do well to have a portion of bonds because they're more fixed. But I think everyone should have at least some stocks, because you're not just investing for yourself. Who knows how long anyone can live? You know, we could be around, like we might all be around in the next 40 years. You know, so you want to build these investments over time and also pass it on to the next generation. When you pass away, those stocks, as long as it's under like $11 million, those stocks pass tax-free to the next generation. So it's pretty cool, with some exceptions on certain accounts and stuff. But and these are the types. Real quick. So over the last 90 years, stocks have returned 10% nominal. That means just like in a year. But if you look at the real net of inflation, they've returned about 7%. And that's over the last 90 years. So different periods of time have had worse returns or better returns. But yeah, on average, they get about 7 to 10%, depending on what time period you're looking at. And net of inflation, that's about a 6 or 7% growth. And the purpose of stocks are for long term. If you're not investing, if you need the money in less than 7 to 10 years, you should not be investing in stocks. I'm going to say that again. If you need the money in less than a decade, you should not be investing in stocks because they are risky in the short term. You might lose your money if you have to sell when they're down. Next are bonds, and they're a great addition to most people's portfolios because they kind of smooth out, in combination with stocks, they're negatively correlated, meaning so when one goes up, the other one tends to go down. And the reason for that is the demand. When stocks crash, people are fleeing the risky stuff for safer stuff. So they go up and down separately, right? And they return about 3% after inflation a year. And they're good for like the medium term, you know, as like if you're retired, they're great for income. You know, they don't pay very much right now. It's kind of crazy, the low and negative interest rates. And they're also good as a hedge, like against inflation or as a hedge against the riskiness of stocks. Next, you have cash, which you really should only be using for short-term and emergency. And because cash, it's very difficult to get anything on over 1% right now, so you're actually losing purchasing power. Next, we have among a lot of people that gold is an investment. It is not. It is an asset. It doesn't appreciate in value. You basically, you have a chunk of gold, you can buy the same thing 1,000 years ago as you can 1,000 years from now. So it basically maintains your purchasing power. That's all. And it has some industrial uses, obviously, but that is my take on precious metals. They are just a hedge against inflation. And next you have like real estate and business. These are other asset classes that people do. I'm not really into, so I can't really tell you much about it. But it varies, you know, and you could do it from medium term to long term. And next you have risk mitigation things like annuities, insurance, and derivatives such as options and futures. And those things reduce your risk. And next you have derivatives and speculative investments, and these are your moonshot investments. These are the super gambles. This is money that you're throwing away, you know, kind of like buying a lottery ticket. This is money that you're gambling, okay? So if you have the appetite for this kind of risk, go for it. But I wouldn't recommend putting more than like 10% of your portfolio into risky stuff like that, like speculative stuff. And here's a graph of what something $1 back in the beginning of the 19th century till December 2013, what it would have returned. So $1 200 years ago would be worth almost $1 million back in 2013. So it's probably double that by now. Bonds would have returned about $1 would have turned into 1,500. Short-term treasury bills would have turned into about 300. Gold would have gone up slightly to about $3 in value, and the dollar itself would have declined to about a nickel because of inflation. And this is since 1975. You'll see that gold and the consumer price index, the blue and red, are basically neck and neck. And that's, like I said, gold doesn't make you any money. It maintains its purchasing power. And then here you have investment grade bonds and the riskier stocks and REITs, which are real estate investment trusts. And that's a way of investing in real estate without actually owning the real estate. You're just basically investing in stocks and stuff. But they're good for like retirement accounts because they pay a lot of, they pay dividends and stuff like that. So general investing advice, diversify your money. Don't ever put all in one basket, all your money in one company. I know people who like put all their money in like Bitcoin when back in, I mean, it's going back up now, but they put it in like December of 2017 when it hit its peak and then they lost their money. You know, people that borrowed money, anyway, I have someone in my family who borrowed money, who got duped into a Bitcoin scam and borrowed money to invest in that, and that was all gone. So yeah, don't put all your money in one thing. You know, don't gamble money you can't afford to lose. Stay away from fees. So basically, this is something more with the financial independence community, but expense ratio, they've done studies, and expense ratio of a fund is the #1 performance indicator. And so many financial advisors recommend, as far as if you want to know how much to go in stocks and bonds, I'm not telling you to do this. This is just what many financial advisors recommend. You take a number like 100 to 120 minus your age, and the percent should be in stocks. So I'm almost 40. So let's say 40, right? So if I do 120 minus 40, that's 80. So 80% of my portfolio should be in stocks, and 20% should be in bonds. Does that make sense?
So if you're 70 years old, then 120 minus 70 is 50?
50. You do 50-50. That is a kind of general rule of thumb that a lot of financial advisors recommend. I'm not saying you should do this. You know, I would definitely talk it over with someone qualified, but this is just what many financial advisors recommend. But I don't know why I'm focusing so much on this. All right. So yeah, do your own research, educate yourself. There is no safe get rich quick method. All right. So understand that there's, you know, anything that gives you a lot of reward is going to have a lot of risk. You know, and most importantly,
our Wells Fargo.
Basically, what I wanted to say, that habits are more important than knowledge. You know, I had good money habits from a relatively young age. So, and I consistently invested, and that is what counts, not what you know. It's not what counts. You know, there's many smart and educated people that never do nothing with their life. So that's really what counts. And so if anybody was, I can talk about this later if you want, but we're like, okay, how do I get started investing? It's as simple as opening a brokerage account. That can be online in places like Vanguard, Fidelity, E-Trade, Charles Schwab, any of those big companies, or even the Robinhood app. Now that's, I wouldn't recommend it right now because of what the recent happenings, but there's many other mobile platforms that you can use to invest. So yeah, you just open a brokerage account, you transfer some money, you type in the search bar what the stock you want, or the ETF or security or mutual fund, and you click buy, and that's it. That's how you get started investing. We can talk about this later if anyone's interested. All right, so resource. So I have a website called dollarbills.com.
It's a good website.
So yeah, this is my website, right? So these are the last three. This is where I write. If anybody's interested, check it out. Dollar Bills. That's dollar and then BILZ.com. And this is where I talk about how I went from 0 to $1 million, kind of detailed. This talks about an investment in Tesla I make, and I talk about all kinds of stuff here on my blog. So if anyone is interested in looking at that, this is the about me, just a little bit about me. Here are some resources that I have. I think a lot of people will benefit from these resources. So I have a money file with expenses, with budgeting. So yeah, just if you go here to resources, just click through these. They're pretty cool stuff. Oh yeah, and so starting this year, I started giving financial coaching classes to sessions to people for $99, in individualized, personalized coaching sessions. So I go through debt reduction and expenses and budgeting and stuff like that. Like I talk to people, I help them set up a retirement account, stuff like that. So I want to leave you guys with this, and I'm sorry it ran a little long, but that is the end of my presentation.
Thank you, Paul. I'm going to stop recording.